Okay, guys, you are welcome back to this section, and you are once again welcome back to Larbi Premium Consult. So, as we started yesterday, we discussed the issue about the correction of errors. Okay, and then today it is day two. We are continuing with. Guys, you are welcome back to this section. We are continuing with the day two as session two of our journey that we started that of yesterday. Okay, but then before we look at manufacturing account today, I would like us to go through some correction of errors, some of the practical questions before we start with the manufacturing account. So if you are new on this channel, make sure to hit the like button and then share this video and even subscribe to the channel so that once we go live you get it right away, so that you can also join us to learn together. So you are welcome back once again. So that is what we would like to do for today. So that is the objective. Here we solve some questions. We start some questions, and also we also start with the manufacturing account, so we revise on it so that we know our position in that case. So that is that. So let's get started, but let's try to also to invite our friends to join this live stream so that they can also learn alongside in that case. So let's do that. It will help us. All right, so also then let me also see where you're also watching us from. Let me also see where you're watching us from, so that it will help us to also to know how or which topic we should always prepare to assist you as you engage on your examination in that case. So thank you for joining this stream once again. So let's begin real quick. So as I said, we're going to start with an example with our correction of error that we started. They are in the description of this video. So after that, we journey through with manufacturing account. Or what do you think? Our correction of error we started. They are in the description of this video. So after that, so I think yesterday we started with example. I think this example we solved this particular question actually. The trial balance of Asempa. I think they are on the description section of this video. That's what we discussed. So I want us to take another question on correction of errors. After that, we start with the manufacturing account for today's discussion actually. So let's do that. I want us to take the first particular question here so that we know how to deal with them in that case. All right, so if you are watching us, make sure to take a screenshot of this question. So once I start, you can also follow through with the question that you have taken a screenshot of on the screen. So make sure to take a screenshot of the question on the screen so that you can follow through in that case. So let's read. The bookkeeper of a firm, having been unable to make the trial balance agreed, raised a suspense account in which he entered the difference. The trial balance is drawn as shown below. And we have the trial balance, and then they also prepare their account out towards December 2018. In that case, so more like 31st December. Is that okay? So we have business premises, equipment, sales, purchases, inventory, trade payables, trade receivables, bank rates, general expenses, capital, and then suspense account. That was the difference that arise in the trial balance as a result of an error. And the following errors were actually, upon investigations or upon examinations, they came out with these errors that occurred in the book. So that is what we're going to look out for, and then to correct it and know how to deal with the suspense. Because once you're able to correct these errors, the suspense account will close at the end of the day. So that's what we're going to look out for. After that, we start with the manufacturing account in that case. So let's stay connected, invite friends, and make sure to hit the like button so that we can get more engagement on this video. So let's go back to my board so that we start in that case. So make sure to take a screenshot so that once I join on, you can also follow through in that case. All right, so I'm visiting my board. Come in. Oh, come on. So let's begin with the question so that we know what to do, what is expected of us. I think our expectation is to prepare the journal, pass journal entries to correct these errors, and then the next thing is to also to open suspense accounts and then use the information that you have derived from the journal and then suspense to also to rectify all the errors in the trial balance in that, or correct it in that case. So that's what you look out for. So let's start with the journal. So let's say A, journal entry. So you're going to have a journal entry for your activity. So let's take note of that. So with the journal, you only see 3 items. We have the details, then you see particulars, details, you have debit, and we have what, credit, and we have the currency that also determines so we also have the currencies that also determines what we need to do at the end of the day. So let's say what currency, Ghana cedi signs or currency cedis in that case. So let's take your question, then let's start real quick in that case. Or let me share the screen once again. All right. So the bookkeeper of a firm, we don't know the firm, so actually that's why we have started straight away, right? So these were the trial balance, and the suspense account here was what, 1,000. So let's start with the first transaction. It says, upon examination of the books, the following errors were detected. A, the purchase journal had been undercast by 75,000. The purchase journal has been undercast by 75,000. The purchase journal has been undercast by 75,000. 75,000. So how do you correct this error? We said that undercast form part of which errors. I think yesterday we talked about them, the various types of errors that we have in the books of account. We said undercast is part of errors that will throw the agreement of trial balance out of order, meaning that the debit and credit side won't agree, and we're going to create what? A suspense account. So here it is what? A single-sided error. The statement A is a single-sided error because here the trial balance wouldn't what? Agree in that case. So let's take note of that. Let's take note of that. So how do you correct it? Let's see how we do the correction. So A, it says that the trial balance, so the purchase journal had been undercast by what? 75. You know, purchases have a debit balance, right? Purchases also have a debit balance. So if it's undercast, then all that we need to do is to add back the difference to the purchase account. So all that you're going to do here is to have your purchase account here, purchase account, which is undercast, right? And tell us that the undercast figure was what? 75,000. So you write here debit 75,000. I hope that is clear. And then the difference, since there's an error that will affect the trial balance, the difference is going to be catered for by the suspense account. I hope that is clear. So here it becomes what? Suspense account, which is what? 75,000. So that is what we need to know when it comes to the undercast. So after that, once you are done, you need to have a narration. Because journal, you need to have a narration in the journal. You tell us that purchase undercast now corrected or purchase undercast corrected. That is the narration. That will tell us more information about the item in the journal. I hope that is clear. So that's. So if you have any question, let me see in the comment section so that we know how to deal with it. And then transaction B, it says goods bought from a supplier amounting to 185,000 had been posted to the credit of his account as one. So we were having goods of 185,000, right? That we bought on credit from a supplier. Instead of we crediting the supplier account with the 185,000, and then debiting our purchase as what? 185,000. We actually had this figure being correctly debited in the purchase account as 185, but then in the supplier's account we debited it with what? 158,000. So this becomes what? Which type of error is this? Which type of error is this? So here it becomes more like a single-sided, which has been what? Reduced. More like, how do I put it? Let's say there has been transposed, a single transposition of what? Errors. You see the figures, it was 185, but here it's what? 158. It can be a single transposition, or it can be one-sided one-sided error of original entry. One-sided error of original entry, which doesn't follow suit with the normal figure that we are having it here, and that becomes what? An error. So you need to correct it. So first thing that you need to know here is that with the creditors or the supplier's account, you need to have a credit balance. So since this was the figure that was in the supplier's account, you need to find the difference between the original figure and then the wrong figure that they have reported in the books. After the difference will tell us that this is what you're going to credit it to the supplier's account. The difference will be happening in the suspense account. Remember, this one was done in just the supplier's account only. That's the creditor's account and not the other account. So that's why the difference will go into the suspense account in that case. So I hope that is clear. If you have any question, kindly let me know so that we'll know how to deal with it. Okay, Karen says Blair. I think you need to check your connection. Yeah, I think that was slides I've put up. You need to check your connection. Check it all, right? That is what we are actually talking about. That's what we are talking about in that case. So let's see how we correct it. So first of all, we find the difference between 185. So let's see, what is the difference between 185,000, 185,000 and 158,000. What is the difference? What is the difference? Let's see with my calculator. 185 minus 158. I had over 27. So let's see whether you get the same thing as 27,000. That is what I got for the difference. That's what I got for the difference. So this difference is going to be what? Credited to the supplier's account, right? And then the difference or the other account is going to be taken into account is going to be a suspense account, since it was done just on the supplier's account only in that case. So let's take note of that. All right, so let's record in that case. Let's record in that case. So here is going to be suspense account, which is the difference of 27,000, and then you're going to have suppliers account, or more like creditors, right? Suppliers account is also what, 27,000, and I hope that is clear. All right, so once you get that, that is that, and you tell us that suppliers accounts undercast now corrected. This is a single undercast error on one side of the account. Now let's look out for transaction C. It says a check of, let me try to open it for you here. It says C, a check of 160,000 received from a trade receivable and paid to bank had been dishonored. Nothing concerning the dishonor had been entered in the books. Realize that we receive what? A check of 160,000 from a debtor that we supply goods to him or her on credit, and then this debtor paid us with check. So the idea is that at any time business receive check, it first of all need to send a check to the bank, okay, so that they can, the bank can also rectify the check and then make payment to the business or its account. And this is what happened. When they received the check, they did so clearly, they sent it to the bank, and then the bank told the business people or the business that this check that we are receiving is a dark check. We cannot honor the payment. So you need to return back to the drawer. So they write on it, RD, return to the drawer. He's the one that you need to return to, because the check is a dark check. Probably maybe the amount in words differ from the amount in figures, or it can come a whole lot of reasons that can result in what? In a dishonored check. So when they return back, instead of they returning the check to the debtor, they fail not to record, and they record it as if it's a amount that they are receiving. So that is what they did. So they record the check when they went to the bank, and then the bank dishonored the check. They came back into the business and then recording their books as if they have received money, and they debit the bank account of the cash book, and then they credit the debtor. That's what they did, and that's an error, because here you shouldn't even record it at all. Once you receive, you shouldn't even record it at all. Once the bank state that this is a dishonored check, you shouldn't even record it at all. And then you reinstate the customer's debt that you own in the debtor's account. So let's see how they treat it so that we get to try it. So this is a case where we have the check, so this is where we have the case of the check as being represented as what? Bank, and then we also have what? The debtor. And this is why the business, after they sending the check to the bank, and the bank said that we cannot honor this payment into your account, instead of the business people coming and to send the check to the debtor, they fail not to do that. They record it in their books again. This is what they do. So they actually recorded the 160 as if it's the payment at the debit side, and then they also record it at the credit side of data, because once payment is done, the creditor one making the payment is going to credit the data, credit the giver, you credit the giver, then you debit to the receiver. So the bank is receiving, so going to debit the bank, and then the data is the one giving, so we credit the data, and that's what the business actually did, and that's an error. Actually, you shouldn't record. So for you to cancel that error, what are you going to do? All that you need to do is to first of all cancel the error that they did in the boost, right? First of all, cancel the error that they did in the boost, and then after that, you record the actual error that they made. So that's what you're going to do. So it is what you're going to do. You first cancel the 160 here. So let's say if it was at the debit, you cancel it. Is that okay? You cancel it at the credit side of the bank, and then debtors to which was at the credit side also cancel it with 160, and then you actually record the amount that the debtor was owning us. That is all. That is how you're going to do it. So you're going to debit debtors account, then you credit bank account, so that it will cancel off, and then you're going to have the debtors amount being standing as what 160 in his account. So that's what you need to do in that case. I hope that is clear. If you have any question, let me know how I can assist you in that case. Alright, so all that we'll do here is to say that here debtors account need to be credited with what? Sorry, I think I've explained it. Okay. Debtors account need to be debited with what? 160,000. Hope that's clear. And then you also credit bank account as what? 160,000. 160,000. Then we are done. And you tell us that check this standard now what? Corrected. Actually, that's how you're going to do. Or debtors account which was wrongly what? Posted, now corrected. I hope that is clear, so then you move on in that case. So if you have any question, let me know. Okay, so far no question. So let's move on to transaction D. Transaction D is also saying that an item of 8,000, right? An item of 8,000 entered in a sales returns book had been posted to the debit side of the customer account who returned the goods. The item D, let me share my screen so that you see the question I'm talking about, or the statement. It says an item of 8,000 entered in a sales returns book had been posted to the debit side of the customer who returned what? The goods. The customer is the one who returned the goods. So the double entry rule is saying that if a customer returned goods, then he's the one giving, so you're going to what? Credit that customer. That is the rule. You're going to credit that customer. But here is the case where instead of you crediting the customer, the good accountant actually debited the customer as if the customer has received what? Goods from the business. So that is the error that they made. So let's take note of that. So we are going to correct it by first correcting what the wrong entry they made. That is by crediting the customer's account with 8,000. Okay, after that we will record the actual 8,000 at the credit side of what? The customer, so that to cancel off the 8,000. So we need to first, we will take twice of the 8,000. Okay, we take twice of the 8,000 and we credit to the customer's account. After, when you balance it off, you are going to get 8,000 being at the credit side of the customer's account. I believe that is clear. So let's take note of that. Let's take note of that. So let's look at it. So that's what they so here, here's how you're going to correct it. You tell us that the customer who you should have been credited was debited. That was a mistake, and it was just in the customer account only, and not any other. So here the error here is going to affect the trial balance. The trial balance won't agree, so you're going to have what? A suspense account to cater for the difference. I hope that is clear. So here is going to be suspense account, then you're going to take twice of the 8,000, which is what? 16,000 has been debited, and then you tell us that customer account or debtors account also being credited as what? 16,000 in that case. Then you are done. You tell us that customer account wrongly what? Entered, now corrected. That's the narration. Customer account wrongly what? Entered, now corrected. Or debtors account wrongly done, now what? Corrected. Please, I hope that is clear. So that is the main, or how you correct it. Is that okay? Yeah. So let's take note of that. So let's continue with the rest so that we get it off and we continue with our manufacturing for today. So let's see transaction E. Transaction E. Transaction E. With transaction E, we are told that an equipment sold at 50,000 had been entered in the sales day book. Has been entered in the sales day book. Yes. The total of which so that is what we are talking about. With transaction E, it said that an old equipment at 50,000 had been entered in a sales day book, right? Entered in we sold it, but entered in the sales day book. The total of which has been posted to the sales account. So this is a situation where we sold an asset that cannot be used by the business anymore, and then instead of the good accountant recognizing the asset as what machine disposal or equipment disposal, he actually recognized as if it's part of the stock that we sell to our customers, as part of the current stock that we sell to our customers, and that is what they recognize it in a way. So that is an error. It's not part of the stock that we sold. So for you to correct, you being a good account, for you to correct it, this is what you're going to do. So this is what they did actually. You know, sales have what? A credit balance, right? So if there is a sale, then automatically it's going to be at the credit side of for the sales. So the 50 was made at this side in the name of for the machine disposal. That's what they did. I hope that is clear. All right. So instead of they crediting in a equipment disposal account, equipment disposal has been at the credit side here, they actually credit in the name of sales. So for you to correct this error, all that you need to do is to cancel off the 50,000, which shouldn't be part, because in that case the 50,000 will cause the sales to increase, which is not true. So for you to do that, you need to cancel off the 50,000 from the sales account. How do you cancel? You cancel it by what? Debiting the sales account, and then you come and credit the equipment account. That will tell us that this what? Equipment disposal. And this error is called which error? Which error is that? I'm in transaction E, where an item changes from a class to another class. What error? What name did we actually talk about? I think yesterday we said such error is called what? Errors of what? Principle. Errors of what? Principle. So let's take note of that. If you couldn't be able to join that of yesterday's one, the links are in the description section. After here, you need to take your time and go through so that you get things right. Thank you. So let's do the corrections. Sorry. So let's do the corrections here so that we get things done in that perfect manner. So all that I will do here is tell us that sales account need to be debited with what? 50,000. I hope that is clear. And then equipment disposal need to be credited with what? 50,000, so that we know that actually it is an equipment that we are selling, so it shouldn't be part of the normal current stock that we actually sell to customers. So let's take note of that. So that is transaction E. Let's move on to transaction, I think. So it tells us that equipment account wrongly what? Or not entered. Let's put it that way. Equipment account not entered, now what? Corrected. Now we have entered this, so it's now what? Corrected. So let's take note of that. Then let's move on to transaction from E, move on to F. In that case, I think from F we are left with 2. Okay. And F is also saying that an amount of 45,000 owing to a supplier had been omitted from the list of what? The sundry trade payables. Here is a case where we prepare individual account and we are extracting the trial balance. Instead of we bringing that balance from that trade payable, we fail not to bring it. So that becomes what? A single what? Sided error. That's partial omission of balances existing in the books of accounts. So in this case, once they have been omitted, all that you need to do is what? To rectify it by what? Bringing back into our books again, by recording it again. Actually, that's what you're going to record. So just record the one that was what? Omitted in that case. So here, you know, trade payables are credited and they have what? A credit balance. So it's going to be credited, and the difference happens in the suspense account. The difference is going to happen in the suspense account. So let's take note of that. So tell us that here is suspense account, which is what? So the figure was, let's see the figure. The figure was 45,000. So 45,000, and then you tell us that the other account is what? Trade payables. So that's creditors. creditors account. You also write it as what, 45,000, and you are done. You tell us that creditors account not recorded, now what, entered or now corrected. In that case, then you are good to go. So let's continue with the two transactions, then we move on to operation of suspense and then the rest. Continue on that light. So from F we move on to, let's see, let me share my question here with you. So we move on to G. With the G, they are saying that a discount amounting to 4,000 allowed to a customer had been duly entered in his account but not entered in a nominal ledger account. Here we know that discount allowed are basically incentives, cash incentives that we give to customers in order to encourage what, prompt payment. But here is a case where once we allow the discount, it has been recorded in that customer's account, but then instead of you recognizing that same amount as being expense as against the business, as being expense for the business, we didn't record it. Because remember, discount allows an expense on the side of the business, it's an expense to the business, but then on the side of the customer, it's more like an income to the customer. Is that okay? To the business an expense, but then to the customer is what, an income. But the customer has enjoyed part of his discount, but instead of we recognizing the discount as part of an expense, so that we recognize in our profit and loss as part of an expense, we fail not to do that. So here it becomes what, a single-sided what, omission, a single-sided or partial what, omission. We didn't record at all, so you need to record it. And since this error will affect the trial balance, the difference is going to be catered for by the suspense account. The difference is going to be catered for by the suspense account. So let's take note of that. Let's take note of that. So here is going to be discount. You know, discount expense is going to have what, a debit balance. So tell us that discount allowed, which is what, so the figure was what, 4,000. So just record it, and then tell us suspense will cater for the difference, which is what, the 4,000. The suspense account as what, 4,000. In that case, then you are done. And then the last transaction, that is transaction H. We were told that an amount of 10,000 being rate treated as prepaid in a previous year had not been brought forward as a balance on the rate account. Here is a case that the business paid what, rate in advance. That's the business, they pay rate in advance, and then anytime business pay any item in advance, it's being recognized as being what, an asset, right? In terms of current item, in terms of current in nature. If the item is current in nature, then it's recognized as being what, current what, asset. Prepaid is being recognized as what, current what, asset. But here is the case where we're extracting the trial balance, but instead of them bringing that of the previous rate that we as prepaid that we paid, they didn't recognize it in our book, so they failed not to bring it. So this is a single what, omission, right, or partial omission. So for you to recognize this, and this, since this is a single-sided error going to affect the trial balance, the difference is going to be catered for by the suspense account. So all that you need to do here is to tell us that prepaid rate, which is an asset or current asset, need to be debited, and then the suspense account will take care of what, the credit balance in that case. So that is the whole show in here that we are trying to put across. So let's take note of that. So all that I will tell you is that here rate, I will just repeat it. Let me just record it again. So rate, and what was the rate figure? So the rate account, the figure was what, 10,000. So just write here 10,000. Okay, and then you tell us that suspense will take care of the difference. Suspense account will take care of the difference. So suspense account will take care of what, the difference that will around, that is going to be, or you tell us that rate balance omitted now entered. Rate balance omitted now entered. So always narration is important for you to write narration. After correcting, you need to write narration so that will tell us that this is the transaction that you are talking about in that case. So let's take note of that. So that is the journal that we have prepared so far. So if you have any question, let me know in the comment section so that I can attend to that question in that case. So let's continue to prepare our suspense. So in the preparation of the suspense account, all that you need to know here is that all items that have an element of suspense here with respect to the balance that it has been posted in the journal, just recording the suspense account, that is all. So for example, let's say A, you have suspense at the credit side. You tell us that in the suspense account, you tell us the purchases in the name of purchasers or suspense being at the credit side. B, in the name of suppliers being at the debit side of suspense. Then you follow through in that case. So that's going to prepare. That's how you go with the preparation of suspense account. So let's take note. So let me prepare my suspense account here. Let me write the piece so that we can. So suspense account. Suspense account. Suspense account. So realize that at the beginning of the period we're having a suspense amount in the trial balance. If you can check, this is here, this figure, the 1,000, that was the amount in the suspense account. So that's what at the debit side of the trial balance. So when you open the suspense account, you tell us that that's the trial balance difference. As a suspense, you tell us that it is being what debited, and that is all. So let's take note of that. So with the suspense, all I'll do here, tell us that trial balance difference, trial balance, can shorten the difference, and you tell us that that trial balance difference is going to be, I think the difference was 1,000, so just record as 1,000, and you are done. So let's come to the journal. So the journal with the A, I'm having a suspense at the credit side with the name of what purchase, so I'll just record credit side. So purchases, which is what, 75,000. Then you come to the B, you have suspense at the debit side, right, in the name of suppliers. So suppliers or creditors. So suppliers as what was the figure? Figure was what, 27,000, right? So 27,000, just record. And then C, we have, okay, so see, there wasn't any suspense, so just ignore. Then you come to the D part, there was suspense in the name of debtors, right, the debit side, so just record debtors, and the figure was what, 16,000, right? So let's come back to the E. So E2, there wasn't any suspense. Then F, we have suspense in the name of what, creditors. So we're going to debit suspense like a name of creditors as what, 45,000 in name of creditors. I think that is so, yeah, creditors or suppliers. So creditors are so being what, 45,000, and then I think with the transaction G, you also have a suspense, but the credit side in the name of what, discount allowed. So I can write here as what, discount allowed, as the figure was what, 4,000. So just record 4,000. Is that okay? And then we're also having a rate in, we're having suspense in the name of what, rate. I've been at the credit side, so tell us that here's what, rate, and then you have the figure being presented as what, let's see the figure, 10,000. So just write it, 10,000. I hope that is clear. So once you are done, let's see whether you're going to balance at the end of the day. So once you're able to correct the errors, if it is right, then your suspense account need to close. You shouldn't have any balance exist in the suspense account. That's what we mean by the idea about the suspense account after proper correction. So let's see. Let's add all the debit side and let's add all the credit side. What are you going to get for the debit side? You're going to get for the credit. So for the credit, I can ascertain that one very sharp. Let's see what you get. Okay, Fred, Ahmed is saying that why is rate debited? Rate in the journal, right? Rate was debited. Yes. Remember, rate was a balance that was from the previous year, okay? And then instead of when we were preparing the trial balance, instead of we recognize the rate as part of an prepaid, which is what an asset being at the debit side of the trial balance, we failed not to bring that balance, and then we left that balance off and we prepared the trial balance, and that's how come we were having suspense. It couldn't able to agree because of these errors that happened. So rate was one of the errors. Instead of we recognizing the rate as being a debit side of the trial balance, we didn't bring it. We didn't bring it, so that becomes an error. So here, for you to recognize, just what record it in the trial balance as what debit side has been recorded. We know rates and in this case, once was prepaid because it comes with the current asset. So let's take note of it. I hope you have gotten it right. Ahmed, I hope you are getting it right. If you have gotten it, then let me know in the comment section in that case. So let's take note. So what are you going to get for debit? What are you going to get for credit? So for credit, I had 89,000. What do you get for the debit side? Let me see in the comment section. What do you get for debit side? Debit, what do you get for debit side? Okay, debit side too, I also had 89,000. 89,000 in that case. So that is with the suspense account and then the journal. So let's touch on with the latter part, so we start with the manufacturing in that case. So let's be sharp. But the manufacturing, you're going to have it in two parts as we had the correction of error. So we can start something and then probably we conclude it tomorrow, and then we start, I think, issues of shares. I think for that one we will use just a day to finish it and try some questions out in that case. So let's just stay focused and then follow through. So we are asked to see. We are asked to, let's see. We are asked to draw up a corrected trial balance. So you see, this is our trial balance that we're having here. So here, let me guide you so that I can even leave out so that you can practice on your own. So this is what you're going to do with a C. This is what you're going to do. You look at all the errors that were made in that was corrected in the journal, and that have a relation with the items here, like let's say premises, equipment, and those stuff. Okay, so if the item that you corrected in the journal have any relation or have any item with effect here, you need to adjust it in that case. So here, remember, we're having an equipment, right? And the equipment, you said that equipment was sold, which was 50,000, but then we couldn't able to. So in that case, for you to know the total equipment that you have in your business as at now, you are going to subtract. I think it was 50,000. You're going to subtract. You're going to tell us that here is 200,000, and you subtract 50,000 from it, and that's going to be the end result. Is going to be at the debit side of the trial balance. Okay, and when it comes to the sales too, I learned with the sales. Let's go back and check something here. I learned with the sales. Let's see with the sales transaction E. I learned with the sales too. We also overcast it with an amount of 50,000. So since it shouldn't have been part of it, all that you need to do here is to rectify the error by debiting the sales, so that you can cancel off that 50,000 that was included in the sales figure. So when it comes to the sales too, this is what you're going to do. You tell us that, look at the figure here, which is what 900,000. You tell us that here is 900,000 minus 50,000. Then you add. So that's what you're going to do. So the one that was undercast, you add back. The one that was overcast, you subtract. Depends on the entries that they actually have in that case. So that's how we actually corrected the error. So I don't want us to waste enough time here. So I'll post the correct answers for the C, the option, draw up the corrected trial balance in my community tab within this channel, so that you can check how it should be done. But it follows the same method. So let's take note of that. So I'll post this question right now I'll post it not necessarily now, but then after we are done, I'll post it on my community tab, and also the answers has been passed, so that you can also take your time to go through step by step, so that you can also follow through with the presentation you have made here in that case. So I don't want us to, so I'll give it to you as an assignment, but then I also post the answers in the community tab. So make sure to always check the community tab to verify your answers after you have gone through in that case. So let's take note of that. Any question? Any question? Any question? Okay, 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 that's good. So there's no question in that case, so let's continue. So let's start with our manufacturing account. Let's start with our manufacturing account so that we can go in that light. Let's start with our manufacturing account. So let's start with our manufacturing account. So like guys, let's invite friends to join. It seems we have just 3 people online. I don't know whether per my, yeah, we have just, I think one just joined. So let's invite friends to come and join so that we can all learn together in that case. So let's take note of that. All right, so let's start with our manufacturing. Let's start with our manufacturing account. Come in. So we are going to, the next thing you're going to talk about is going to talk about manufacturing account. You're going to talk about manufacturing account. We're going to talk about manufacturing account. Manufacturing. So accounts for manufacturing organizations, accounts of manufacturing organizations, account for manufacturing organizations. So when you heard of the word manufacturing, what do you mean by manufacturing? We are saying that manufacturing has to do with the process of, it's like more like production, process of bringing something or creating something new into the existence. I mean, process of what, bringing something new into being. That's what we call manufacture. So you come out with some materials, or you come out with some ideas, you put them together, and you come out with something new. So in relation to businesses and come to the selling and then buying of goods and services, there are some organizations, okay, who for them they are not interested in buying the finished product from the market and resell back to the customer, but then for them they are interested in manufacturing the product themselves or making the services available from themselves or from the activity. So that is the goal of the manufacturing organization. For them, they are not interested in buying the finished product outside, but then they are interested in manufacturing the product themselves so that they can resell to their customers. And if we have such organization in place like this, then for them we need to prepare a manufacturing account for them. We need to prepare what we call a manufacturing account. So you realize that with them, they don't just start up and then they start to prepare anything. They must come out with some process that they will follow through at the end of the day, so that they will get the goods or the service being available to the customers. So for a manufacturing organization, they will acquire raw materials. They will acquire raw materials from, let's say, a supplier or a creditor. Okay, so after they acquiring the raw materials, right, they will then undertake certain processes to transform the raw materials, and then going through certain stages before the raw material becomes a final output, and that becomes the finished product, and then they will sell out to their customers in that case. But remember, in the process of selling it, they are not going to sell it at the price that they sustained in getting the material, but they're going to add up certain profit to it, right? So that will help or to ginger them to also to engage more, because no business or no businessman or businesswoman will start a business with the aim of not making profit. Every business organization, if the profit business making organization, they have the aim of making profit, and also to continue with the business in that case. So for them, they will consider the cost that they incurred for manufacturing the item or the product or the service, and then they'll add up an element of profit, so that they can also have a fair share of returns based on the investment they are making in the manufacturing of that product, or in the making of or in the providing of that services. I hope that's because that is the idea about manufacturing organizations. But you realize that we have some other firms who, for them, they don't manufacture. They go outside and then get the raw materials, so they get the finished product, and then they will sell back to. So for those people, you see them as being retailers. But then you see, especially when you're on the street side, you see those selling foodstuffs, handkerchiefs, some ice water and those stuff, and pure waters and those stuff. They're all finished up, then they are selling it back to what their customers. For them, we call it buying, selling and buying what organization. Selling and buying. That's more like buy and sell, games. But then the one that manufacture the product themselves, they actually manufacture it and get the finished product and then sell it out to, because we call it making it in-house and sell it out to the external people. So that is the whole concept when it comes to manufacturing goods. We have those that manufacture the product themselves and sell it back to the customers at a profit, and then we also have those that buys the product, finished product outside and sell back to the people also at a profit. So we are going to analyze how the two also comes into play in relation to manufacturing accounts. And as I said, with those who manufacture the product, we prepare a manufacturing account for them. We prepare a manufacturing account for them, and the manufacturing account that involves here is going to be their manufacturing trading profit and loss account, their manufacturing statement of financial position. At this level, that's what we need to know, but you can go on to add other statements, but then we are not interested in that. We are just interested in the manufacturing account of trading profit and loss, and then the manufacturing account of that is the manufacturing account of the balance sheet, the statement of what the financial position, and that is what we are interested on in that case. So let's take note of that. If there is any question, can you let me know? Make sure to invite friends, make sure to hit the like button so that we can get more engagement. So let's move on. So actually I've defined everything. So the overview of manufacturing account, the others are outlined, the definition of manufacturing elements and classification of course, forms of transfer, sales department, and so these are actually our outline that we're going to go through. So let's take note of them. So as I've indicated, in business, it's believed that most industries trading activities within the market happen through what? Purchase and sales. That's purchase and sales of goods and services. That's those who buy the product from outside and sell back to the customers again. While this is true for most firms who purchase the goods and services and sell it at a profit, it is certainly not for all firms. All firms here means that it's not for all business that actually get the product outside and then that's finished product outside and then sell back. But then we have those also that manufacture, get the raw materials and manufacture the product themselves. So however, there are other firms that do manufacture the product by first acquiring raw materials. Take note of this. By first acquiring raw materials. The first acquiring raw materials. So before they can start with their acquisition, they will first of all acquire raw materials. What next? So after acquiring the raw materials, they then process the raw materials using various processes and ultimately transform these raw materials into finished goods. So that is what we are interested. After they acquiring or procuring the raw materials, the idea is they're going to transform into a good called a finished good that it can be easily consumed by customers. So finished goods of that sort, and these finished goods are then sold by the business, usually at a profit. Let's take note, usually at a profit, because no business person or no business organization will engage in a business without the aim of making profit. Every business organization has the aim of, so they wouldn't sell it at the cost that they sustain with the raw material, but then they're going to sell it by adding a certain element of value to the finished good. After all, the raw materials has changed its value from the raw state to a consumable state. So at least that changes that occur. They also need to calculate the cost of it and add up to so that the customer can pay that cost, and that becomes a profit that they sustain and it becomes a cost to the customer in that case. So that is the whole idea about manufacturing. So for such business, we are saying that manufacturing account has to be prepared in addition to trading profit and loss. I think when I started the introductory, I said all this stuff, so let's take notes. Then what is then a manufacturing account? What is then a manufacturing account? So per the knowledge I've given here, we can say that manufacturing account is an account that is prepared by an organization that are engaged in the production of goods. That's internally, right? They first acquire the raw materials and then use the raw materials to produce goods. Turn the raw materials to finished goods internally. So internally, remember when they turn the raw materials to finished goods internally, they don't just do any magic. No, they first of all need to get people who are skillful enough to turn the raw material into the finished goods, and that cost becomes the cost of labor. And then even if for the business to get the raw material, it must first incur the cost of what acquiring the raw material. So that becomes the cost of what the material. And then those who turn the material into finished goods becomes the cost of the labor. Is that okay? And then any other expense that we incur that help us to turn the materials into finished goods also becomes what? An expense. So in this case, realize that manufacturing account you can define from the perspective of three states as being what? Cost of material, cost of labor, and cost of what? Expenses. That is being manufactured internally. And I know when they manufacture it, they are not going to keep it by their side. They are going to actually release that for people to what? Buy it, and then so that they can get their money back. And that is the goal of what? A manufacturing what? Organization. So that is the idea about manufacturing account. So let's see the raw definition here. So the manufacturing account is an account prepared internally by an organization engaged in the production of what? Production of goods to establish the cost of what? Production. What do you mean by the cost of production here? What do you mean by the cost of production here? We will define from this. After this, we know this. He said to establish the cost of production to be transferred to sales department, indicating various components of cost of manufacturing what a product. The various components of cost of manufacturing a product are what I was talking about as the material cost, as the material cost, as the material cost, as the labor cost, and then as what? Expenses. Cost of the expense. All right, so that is the component of the cost. We get there when you get to classification. So the cost of production, as I was talking about, too, also has to do with the sum of all costs incurred in bringing the goods into their saleable location and what condition. So let's take note of this. It will ask you what is the cost of production. The cost of production here, as we have defined here, has to do with the sum of all costs incurred in bringing the goods into their saleable location and what condition. So it includes all costs that we incurred in getting the goods. Let's say where we acquire the raw materials from to the business, the transportation that we used to convey the goods from where we bought it to our business is part of the cost. Everything. That's why we say the sum of all costs incurred in bringing the goods. If it have a relation to the finished goods, then it should be part of the total cost. So the sum of all costs incurred in bringing the goods into their saleable location and condition. And that's how we define cost of production. So that is a manufacturing account. It's an account prepared internally by organization engaged in the production of goods to establish the cost of production, to transfer to the sales department. We mean to transfer to those that prepare an account, more like the sales department, that sells the product outside. But at the end of the day, when it comes to the preparation of account, they're going to give the information to the accountant so that you can prepare a trading profit and loss statement for the organization. But then the idea is that first of all, after producing by the production department, the final output going to be sent to the sales department, and they're going to market it and then sell it, so that anything that will come out from the sales is being directed to the account, so that you can prepare an account for it, so that whether we know we made a profit or not. So that is the idea about manufacturing account. I hope you are getting values out of this. So let's continue in that case, and then let's make sure to hit the like button, and let's move on in that case. So if you have any question, let me know. If you have any question, let me know. Okay, let's continue. So that is a manufacturing account. So let's look at the elements and classification of, as I said, the cost of production, or the component of cost that is being embedded in manufacturing of a finished goods, are into three stages, or into three components. We have the cost of material, we have the cost of labor, and we have the cost of expenses. So these are the three elements of cost. So they ask in examination, what are the various elements of cost of manufacturing a product or a service? Tell us that the cost of material, tell us the cost of labor, tell us the cost of expenses. So these are the costs we're going to talk about, and these costs are classified into direct and indirect. Direct in the sense that we have those that are directly, or that are attributable to the final product, and we have those that just help enough for us to convert the raw material into finished goods. Get it carefully. Here, the direct I mean here is that we have those costs that are into direct relation or that are attributable. We can identify directly from the product, and we also have those that actually help us to come out with the finished product. That becomes the indirect cost. So all costs we incur in helping or assisting the main cost to transform the materials into finished good, we call the indirect cost. And the direct ones are those that are attributable or that we can identify with the final product. So with a direct one, since they are directly attributable to the product or the service, they are mostly at times what allocated to that product or that service. Alright, but then if it's an indirect, then we are saying that since we cannot identify directly to the final output, it's most of the times what apportioned or shared among what the various what company that or the various sectors or sections that incur such costs in relation to the manufacturing. And what we are discussing here is the manufacturing of what a product. We are talking about specifically manufacturing of what a product. So that is what we need to know when it comes to the elements and classification of cost. We have material, labor, and expense, and in that we can subdivide them into two as being direct and indirect. So we have direct material, indirect material, we have direct labor, indirect, and we have direct expense, we have indirect expense. So as I've defined here, as I said, direct costs are those costs that can be identified, attributable, or traced to a specific product or department within the organization. That becomes a direct what? Cost. And we get to know some of the examples of a direct cost in relation to material, labor, and expense as we move along. So let's take note of that. And we also have the indirect, as I've indicated. For such costs, we apportion it. I think I made mention of this, right? Because we are saying that are those costs whose nature of occurrence make it difficult to be identified, attributable, or traced to a specific product or section of an organization. And hence, since you cannot identify to just product or that section or that department, you need to consider the benefit that those who incur that indirect cost and then apportion them using certain basis of what apportionment, so that it can result in a fair share of what the cost, and so that nobody will actually enjoy high cost and then you enjoy high benefit of it, and then you are going to pay high price for low benefit that you enjoy from that service or that cost. That's what I'm trying to put across. So let's take it. So with the indirect, they are most of the times apportioned. They are apportioned. Let me put it that way. They are apportioned to the department section that incurred it. So that is that. And why do we engage in this division? We are saying that we engage division for the purpose of controlling costs, so that we're in line with what the management has planned to meet for the future. So there wouldn't be any deviation in that case. So that's what we call the control of what cost. We control costs in line that whatever we have put ahead will be in line with whatever we are doing, so that there wouldn't be any deviation. Or even if there is a deviation, we look at what we put ahead and we look at what we are doing, then we compare the output and with the budgeted, then we deal with any deviation and then rectify it. That's all. That's where corrections are put in place. So that is the reason why we divide the cost for controllable what purposes, to control what cost in that light. If you have any question, kindly let me know so that we move on in that case. Alright, so let's move on. So as we have indicated, as I said, with the elements and classification of cost in respect to the material, labor, and expense, they can be divided into direct and then indirect. So for the direct materials, at any time you sum up all the direct materials, sorry, I said direct material, you sum up all the direct cost, it results to what we call prime cost. But when you sum up all indirect what cost, it results to what we call overhead cost. You can call it direct cost or prime cost. You can also call it overhead cost or indirect cost, total indirect cost. And then the summation of the prime cost and then overhead cost results what we call production cost. This is what I was talking about, production cost. So taking into account everything. So the summation of direct materials and indirect materials is going to result in the cost of materials. The summation of direct labor and indirect labor is going to result in what labor, and direction of the direct expense and indirect is going to result in what total what expenses. And that's what we mean by the classification. So here you see we classify some of them that are direct under one category, and we classify those that are indirect as one category as being called the overheads. And then we said when you add up the overheads to the prime cost, you're going to get what your production cost. and that is what we need to know when it comes to manufacturing organization. We don't actually deal with any cost anyhow. We must look out for where the cost is coming from and which sector incurs it and what is the nature of that cost, and then in that case we can have a relation and deal with it in that case. So let's take note of that. So I've said all direct costs result in prime cost, as you can see it here, and all indirect going to result in the factory overheads or overheads cost in that case. We also have various components of overheads that we can talk about, and that is not the objective for our presentation here. So as we move along, if you need to attend to it, we will get back to it in that light. So that is that you need to know when it comes to elements and then classifications of cost. All right. So I've given a further explanations about these costs that I'm talking about. For example, when it comes to direct material cost, we are saying that is a proportion of material which has gone into a production. So it is a proportion of material going into production. In the production essence, let's say we are into the production of, let's say, bread. What are the elements that are directly in relation to the bread that you went to that store, that small market at your place that you went to buy the bread? You always go, sorry, to buy the bread. These are the elements that constitute the bread that you always buy from that store, that small store in your place. It consists of what? Water, some flour, some sugar, some salt, and even some milk to it. These are the components. These are what we call direct material. So the cost of water, the cost of the flour, the cost of the sugar, salt, and milk, these are the direct components of the material. So that becomes what? A direct material cost, because with this cost we can actually attribute or trace or identify with the final out from the bread. At least when you, though you can't easily know or can easily see the water in the bread, but you can see that when in manufacturing of bread with the flour, we need to use water to mix up. So at the end of the day, water is part. At the end of the day, water is part. So you can attest to it in that case. So that becomes what? The direct what? Material cost. Direct material cost. Direct material cost. So let's take it. So direct material costs are costs that are being gone into the production. So let's take note of that. So in ascertaining of the cost of material consumed, we have various ways that we go through. I think when we get to the format for the preparation of the manufacturing account, you get it much more even better. When it comes to the preparation of just the material cost that gone into the production, we first of all start with the opening stock of raw material. So let's say you have a stock that previously that you because you are in manufacturing organization, okay, so probably you might not use all your materials to manufacture for a particular period. You may have what? A stock from previous period. So you are saying that the cost of your material consumed today or in this period will consist of the opening stock of materials from the previous year, okay, or from the previous period, which is the opening stock. So you're going to have that one being here, right? And then if there is any purchase that you made, since you get to know that you can't use just these raw materials alone to manufacture for this period, you need to add up more by buying what? Additional what? Raw materials together with what you have in that case. So at any time you buy any additional raw material, you also add up to your opening stock, but I'm going to add. But before you can even add it, you need to check out whether there was any carriages. Carriages are defined. I think I defined these stuffs in the correction of when we were discussing the effect of errors on the profit. I think I took my time to explain. They have the same relation. Just that here manufacturing, that's why we are having the name change, but then it follows the same what? Format. So here you're going to have carriage. If there's carriage here, means that maybe probably when you purchase the raw material, you couldn't able to carry it along your own. So you hire, let's say, or let's say you bought a car to transport it from where you bought it to your warehouse. So by any means upon which the materials get to your store, that becomes a carriage on raw material. If there's a carriage on raw material, you need to add up to your purchases. And if there was, after, let's say, getting the materials and everything to your store, and then at the end of the day you find out that there were some of the goods that were rotten, you couldn't able to meet up your preference, there was defect on it, then it becomes what? Returns. You're going to return back to the one that you bought it from. That becomes purchases returns on what? On raw materials. Please take note. At times they might trick you. They will tell you that it's purchases return, but then they also tell you that it's purchase returns on raw materials. You should be able to know that here it is purchases returns on what? On raw materials. Take note. Let me add up here. On raw materials. It's important so that you know. So once you hear of purchase returns on raw materials, then you subtract from the total of the purchases and then the carriage. subtract from that, and after that, after subtracting, you're going to get your net purchases of raw material, and you add up to your opening stock. That's where you get your cost of raw materials available for use. Your cost of raw material available for, then you less any closing stock that you have at the end of the day, because after all, you cannot use all the raw materials. So if there is any stock left as raw material, you less it from whatever that was available for use, and then you get whatever you consume at the end of the day, which is what this. So let's take note of that. I hope we have gotten what I'm trying to put across. I hope you have gotten it. So that is what we need to know when it comes to the components of direct material, how we ascertain the cost of material consumed. Cost of material consumed. I hope that is clear, right? So let's take note of that. And we also have direct labor costs. Direct labor costs are also those, as I've defined in my introductory part, that are those that help in the conversion of the raw materials into final output. Remember, they are using their brains, they are using their skill, they are using their energy to do all these stuff. So after all, you need to reward them. You need to reward them, and the reward will come from the payment you're going to make to them, whether in the form of wages, whether in the form of salaries, whether in any form that you made the payment, it should be rewarded. So they should be rewarded in that case. So that's what we call direct labor. So the direct labor cost to, they are those costs that have in relation to the final output of the product, that have in relation with the final output of the product. So here the direct cost here, we mean their cost of labor that can be identified with the product or what the section of organization. So here it's going to be, so at times we want to identify the direct labor cost in the manufacturing, any manufacturing organization questions. Manufacturing or factory what we need, anytime you want to identify this, whenever you see factory wages, the same thing as your direct labor cost, or manufacturing wages, they are the same, or wages. But here you need to be very careful. If it is in relation to the manufacturing, then you add up. By the time you might see wages without they telling you that it's what a factory wages or manufacturing wages. In that case, then it should be allocated directly to what you're trading as trading cost of what wages in the trading account. That's how it should be. But then where you see that manufacturing wages or factory wages, then you attribute to directly to your manufacturing or what wages or manufacturing account as what manufacturing or direct labor cost in that case. So let's take note of that. So these are the things you're going to see: manufacturing or factory what wages. So at any time you see those stuffs, then very sharp, you added out to your direct what cost in that case. And then you have direct expenses. These are other expenses I've said. They are those expenses that are incurred other than the material and labor. So any other cost that we incurred that is directly related to the final output, aside what we have incurred on material as direct, and aside what we have incurred on labor as direct, it becomes a direct expense. So let's say you are into a production of, let's say, production of biscuits, and then you want a special design on your biscuit, and you want to use what a machine for it. You're going to hire a special machine that do that design that you want on that biscuit. That becomes what a direct what expense. That becomes what a direct, because we can see on the biscuit, we can see on the biscuit, that becomes a direct expense. So all that cost that associated with that becomes what a direct expense. Or let's say you are into, let's say you're a publisher, and then you want your product to sell. Let's say you publish books, you write books, you're an author, and you want your product to sell, and then you have seen that there is this competitor in the market that you have feel, but then he has gained, he has captured the market. His brand is so powerful that at any time you attach your product to it, your product is going to sell. So in that case, you are going to look out for that competitor and then seek out for what his what copyright, and that's why we call what royalty. Royalty. So in that case, you are going to pay something based on his brand you're going to use to sell your product. Because then you're going to get, once you use this brand, you're going to what your product is going to sell. So once it's going to help you, they're also going to pay something. That's what we call what royalty. So royalty has to do with, it's a direct expense that has to do with where one uses the right that is granted by someone to use another one's what property in that case. So that's what we see. So when you see royalty here, it's part of what the direct expenses is the right of use of intellectual property as patent, copyright, as trying to say brand, and then those stuff, special machine hide for the production and those stuff. These are what we call direct what expenses. So let's take note of that. Any question? All right, no question. And you also have these elements in the manufacturing, you also see factory overheads. Factory overhead, as I've indicated, factory overhead is a summation of all indirect costs. It's a summation of all indirect costs. It's a summation of all indirect. So all indirect costs within the organization. But here we are interested in those that are in the production. Because you are manufacturing, you are interested in those that are in, because you will have an indirect cost from, let's say, other jurisdictions like administration, selling and distribution, and those stuff. But then here, since we are manufacturing, the factory wage that we are interested here is going to be the factory wage of what? Production. So the factory overheads of what? Production. There's indirect what? Indirect material, indirect labor, indirect expense from production alone. That's what I've defined here. Factory overheads, these are overheads which are incurred in the four walls of what? Production, and they are aggregated of all indirect material, indirect labor, and then indirect expenses in that case. So at the same time we add, so as I've defined here with the direct expense, when you add direct expense, direct labor, and then your direct material, you get your prime cost. So as I've also defined here, the factory overhead, when you also add all the indirect material, labor, and then expense, you also get your factory overhead. So at any time you add the two, the factory overhead plus the prime cost, you get what we call your gross cost of production. You get what we call what? Your gross cost of production. Why is it called gross cost of production? Because you may have, let's say, at the end of the during the process of manufacturing the product, it may not be all the materials that will be coming out as what? Finished goods. There might be what we call a work in progress. And if there is a work in progress existing as at that time, you need to adjust for it. So here I define a gross cost of production as this is a summation of the prime cost and factory overhead cost if work in progress or work in process what exists. So you're waiting for what? Adjustments and deductions to made, whether you're going to add or subtract. Is that okay? So a summation of what? Prime cost and then factory overhead if work in progress or work in process what exists. But if does not exist, then that becomes your final or your net cost of production. If there is no work in progress at the end of the day, that becomes your net cost of production. So but then if it exists, then we need to account for the work in progress, and the work in progress also comes in two forms. We have the opening work in progress and then the closing work in progress. The opening work in progress is those work in progress from the previous year. So how do you adjust it with respect to your gross cost of production? So if there is any work in progress are what we call partly finished goods. We call it partly, not semi-finished goods. You can't have, let's say you have 5 processes. Let's say 1, 2, 3, 4, 5, right? 1, 2, 3, 4, let's say 5 here. And you're telling me that there are some of the material that have transformed to certain stage. And you're telling me that, let's say it has been transformed just this stage. This stage cannot be semi-finished goods. No. For it to be semi, it might be in between. Let's say 1, 2, 3, 4. Guys, let's consider. I was having some network problem. That is why it has been delayed for a while. So forgive me for that. So let's continue. So that's how I was defined with a work in progress. That's what we need to know. It's defined as partly manufactured or finished goods. So let's take note of that. And so they are just giving more information to it. In the preparation of the manufacturing account, as I've indicated, the opening stock of work in progress will be added back to your gross cost of production. Take note, if you have any opening work in progress, it is added back to your gross cost of production. But then if there is any closing, you also less it from your work in progress from it. I mean the total of the gross cost of production plus the work in progress. I hope that is clear. That's how we treat the work in progress. If we have opening and closing, add opening to the gross cost of production, then you less your closing stock of work in progress from it in that case. So the net cost of production here is as a result of the adjustment in the work in progress. So as I've indicated, it is the cost of production after adjusting what? Work in progress. And you also have other costs like conversion cost. These are mathematical. We define conversion. We define conversion cost as what? Your total cost of production. That's your total net cost of production. Net cost of production minus what? Your cost of raw materials. Cost of raw materials. That's how we defined your conversion cost. So these are costs incurred in turning raw materials to finish what, as though your total cost you incur for the product less your total cost of raw materials, you get that in that light. So let's take note of that. If you have any question, let me see in the comment section and I'll attend to it in that light. Let's keep on sharing and make sure to hit the like button so that we can get more engagement and assistance through this channel. And then that is all with the elements and classifications of what cost. That's all with the elements and then classifications of what of cost in that light. So let's take note of that. So now let's move on to talk about after we ascertaining the cost of production or getting the net cost of production from manufacturing, how do we engage in the transfer? Because we said manufacturing accounts an account that is prepared internally by organization that engage in the manufacturing of what goods in order to determine the cost of production to be transferred to the sales department, right? So here the transfer, that's what we're going to look out for. How are you going to do the transfer? Are you going to do the transfer at cost or at what? So in the transfer, you have two options that you can opt to. We have transfer at cost and transfer at market value. So let's look at how this also works. So when it comes to the transfer of cost, here is a case where we just transfer the cost of for the production to the sales department, okay, without any element of what cost, without any element of what profit being added to the cost. That's what we call transfer at cost. You transfer the net cost of production to your sales department without any element of profit. But then if you are transferring at market value, the idea is that you want our finished goods to match up with the market prices. We want our finished goods to match up with the market product in terms of their price. So we are going to add an element of what cost to it. I hope you are following clearly. So that is how transfer of cost and market value works. So when it comes to the transfer of market value, we define market value as your manufacturing profit plus your net cost of production. Manufacturing profit plus your net cost of production. But I hope that is clear. So here is where you have the transfer at cost and we have the two has been the transfer at what market value. Where the market value is defined, we want to meet up or match up with the market products in terms of their price so that we can also sell at that same price to reflect the market and also get some profit in that light. So let's take note of that. So let's move on and let's see more details about. So when it comes to transfer of cost, we are saying that where transfer exists, where transfer at cost exists, the cost of production from a manufacturing account is added to. So we are giving more insight when it comes to the preparation of the manufacturing account in relation to the trading profit and loss of a manufacturing account. So where we are saying that where transfer at cost exists, the cost of what production from manufacturing account is added to the summation of the opening stock of what finished goods. Take note, opening stock of what finished goods and any external what purchases. Let's say we have organization that do manufacture majority, or let's say 80% of their products are being manufactured in-house, okay, or within the organization. That's 80% within the organization, but they also patronize or bought, let's say, 20% out. So for such organization, we call them manufactured in-house, buy out, right? So manufactured in buyout firm. So for them, for you to determine the cost of production, if you are doing transfer at cost, all that you need to do is to where transfer of cost exists. That's what I'm trying to say. The cost of production from manufacturing is going to be added to your opening stock of finished goods in the trading account and any external purchases, if any, to arrive at the cost of goods available for what sale in the trading what, as I was dictating, the trading what account. That is how it engage on. That is how we engage on with the transfer at cost. There is no element of profit, so we just transfer the cost to be part of the opening stock of finished goods and any external purchases, and then, if any, to arrive at your cost of goods available for sales in the trading account. But when it comes to transfer of market price, here, this is where there is a profit margin. As I was saying, there's a profit margin added to the cost of production. And the reason, as we always add, is to determine the efficiency of production cycle. The efficiency of production cycle here, we want to ensure that our products are competitive, because we don't want to sell any product below the market what price. So that makes your production cycle to efficiency, or efficient in that case, and as well as to ensure uniformity of cost of goods sold. That's what I was indicating, that with the market value, we want to match up our product cost or product price with the market product in terms of the price. So if you want to do that, then you engage in the uniformity of what cost in that light, and that's how come transfer of market value is done. So when it comes to the profit here, as you move along, you get to know that we have profit that we call profit as being margin and profit as being what markup. When you hear of profit margin, we are talking about profit that we always, or profit percentage that we always work on the sales, the selling price or the market value or the manufacturing. And you also have markup. Markup to is also applied on cost of what production or net cost of production. So that's what I'm saying. When it comes to profit, we also have subcategories, two subcategories. We have the one, we have margin, and you also have what markup. Margin is applied on sales, and markup is applied on what? On cost. Markup is applied on cost. Markup is applied on cost of what? Cost of production or net cost of production. So that's how we work it out. Margin on sales, markup on cost. So let's take note of that. Then we'll talk much more about when we move along. So we continue. Where transfer at market value exists, the market value of goods manufactured from the manufacturing account is transferred to trading account, and this is added to the summation of the opening stock as we engage in the transfer at cost. The same thing added to opening stock of finished goods and any external purchases, if any, to arrive at your cost of goods available for sale and in the trading account. But then remember, since at market value you add a profit element, you are going to also transfer, when it comes to the transfer, you're going to also transfer the profit on manufacturing to also to be part of your gross profit in the trading account. So let's see. I think I made emphasis on the yes. So any profit on manufacturing too is also transferred to the trading account as part of your gross profit or loss for the period in that case. So that's how these transfer are undertaken with respect to at cost and not at market value. Any question? Any question? Any question? Any question for me? Okay, so let's move on. There's no question so far. And this is the format for the manufacturing note account. This is the format for the manufacturing note account. So you see the vertical format. This is the vertical format actually. So with the determination of your cost of raw materials consumed, I think we have dealt with it. This one, cost of raw materials consumed. Okay, you start with the opening stock of raw materials here, right? Then you start with, so this opening stock is the previous stock. Then if the previous stock cannot meet your manufacturing or production for that particular period, you need to get more raw materials so that you can add up to the opening stock. So you're going to get your purchases, you buy some outside as raw materials. Then how you convey the materials into your business is what we call the carriage on purchases of raw materials. Also add up the cost to it. And then if there was any returns based on defect on the materials, based on this, on that, or that, you also return it. You also less that purchase returns from the summation of the purchases and then carriage on raw materials. And then at the end of the day, you're going to result to your net purchases. You add your net purchases, which is this, to your opening stock, and you're going to get what your cost of raw material available for production. And then you less any closing. At the end of the day, if you couldn't able to use all the raw materials, you less the closing that you get to know of your cost of raw material that you consume at the end of the day. So let's take note of that. And then it follows through that after getting your cost of raw material consumed, you also add any manufacturing wages or factory wages. That's your direct labor, and then any expenses, that's royalty, also add up. That will result in your prime cost. And then you start with the factory. I think we have defined all these things in the explanation. So these are actually the formats that you need to go through. But I know when it comes to the trading part, you are aware of the format. So for that one, shouldn't be any problem for you. So the factory wise, factory lights and heat, factory rent, depreciation of plant, then work in progress. I was talking about how we define them. So actually, if you follow through the explanation that we gave from the beginning up to now. This format should be in your your fingertips, so that you can, at any time you're given a question, you can easily work it out and then get it right. So that is the format that we go through when it comes to the manufacturing account in that case. So let's take note of that. So we also have treatment of provision from realized profits actually. So we will go through them, but they are not all that difficult. I think you can go through them so that we can move on in that case. So I think from there we can have some question to solve. So if you have any question, let me know before I know whether to continue or to end here, so that we continue our discussion, God willing, tomorrow. Is there any question? Okay, no place. So let's say no place. So that seems your members, they are not here. Wow. Okay, so guys, let's end here for now. So we'll continue with a practical question on manufacturing account probably tomorrow, probably the same time. If there is a change in time, I'll communicate so that you get to know. And I also have some information from my students that some of you wanted us to solve some questions on errors that you think is like, so I'll get in touch and I'll make sure to post all the questions and the answers in my community tab. So when you visit the tab, try to access the question and the answers there. I'll try as much as possible to post those questions there in that case. So I think we need to end here and we'll continue, God willing, tomorrow for a live discussion question. So I'll see you. Make sure to hit the like button and then subscribe. I'll see you. Bye bye for now.